So here is the 15-minute on GU. Now, generally, if you are going to be scalping on the lower time frames, you want to pick a pair that has lower spread than other pairs because you don't want to be taken out of your trade due to spread. So trading any pair with low spread or an ECN account is beneficial in this regard. So having said that, I particularly use GU as an example, but the same can be applied on any pair as long as your spread is low and also you are either trading on a standard account. And if you're not trading on a standard account, you should be using an ECN account to trade scalping because your spread will be low on any pair. So without further ado, let's continue here on the 15-minute time frame for this particular pair on GU. And the same what I've taught you based on the institutional order flow, we will do that on the 15-minute time frame. So let's look at this. This large move to the upside over here is a 1, 2, 3, 4, 5. So this move with these 5 candles over here is one large green candle on a higher time frame. Well, because this is a 15-minute time frame, so the more data is showed to you on the chart, the more it appears on a higher time frame. So you can see there, this is a 1-hour chart. Look at that green candle on the 1-hour chart. So looking at again on the 15-minute, it is multiple candles on the 15-minute chart. So knowing this, we can then say that when this gets traded through, like it does here, that this will become an order block, because when price trades through the green candles or bullish candles, that becomes an order block, okay? Because all of these orders are being replaced by sell orders over here, okay? So this becomes an order block, okay? Now this is a 15-minute chart. So on some higher time frames, these smaller bursts of price to the upside were just wicks. So if we look at the 15-minute, you can see that, or sorry, 30-minute, this is a wick just to the upside. On the 15-minute, it shows you a long bullish move to the upside and then a move to the downside. So this is an order block because these green candles were traded through. They were traded through by this candle over here. So you can see move to the upside, move to the downside. Look at that. On a high time frame, that becomes an order block. So if you are trading on a lower time frame, you just need to pay attention to the time that this is occurring, not the actual time. I mean over here, 1 o'clock, 2 o'clock, 3 o'clock, whatever. I'm not talking to that. I'm talking about the candles that are being moved to the upside, because each candle represents 15 minutes. So when you see something like this, you know that on a higher time frame, this becomes an order block and you can trade it based on the 15-minute. So look on a higher time frame. You can see the reaction based on this 15-minute. Look at that. This goes up to the upside and then to the downside, creating ourselves an order block because these green candles or bullish candles were traded through, and that in essence is what an order block is. When green candles or bullish candles are traded through, or black candles or bearish candles are traded through by bullish candles, that is an order block. There is blocks of orders that are being executed. So having said that, let's follow the order flow based on the 15-minute. So if we follow the order flow, we can see that when price rallied up here from this order block, we created ourselves another order block. Price rallied up and created another order block over here. And you can see that when this order block gets created and tested, price rallies up and continues up. And again, an order block. And this order block is responsible for this move to the upside. This here, this order block is responsible for the last move to the upside. 1, 2, 3, 15, 15, 15. So when price trades through that order block, that becomes our breaker, just like I've showed you on the 4-hour. So that is our 15-minute breaker. And this is our source candle, because that is the peak formation high of the candle. So that is 15-minute breaker, 15-minute source. And if we pull this across, we wait for the retest, and there is our entry. So we can see here that price reacted from our 15-minute, having followed the order flow from this side all the way up. We have our source, we have our breaker, price broke, creating our breaker. So this candle here is responsible for creating ourselves a breaker. Then price came back up and rallied into our source, because our source can also be tested. So you can see our source being tested, and generally on the lower time frames, your source will be tested more often than on the higher time frame. But nonetheless, our source and our breaker was tested, and boom, a move to the downside. Well, you ask, where can I get into a trade here? Well, it's quite simple, really. If we know that order blocks appear on lower time frames as they do on higher time frames, we can see where order blocks are. So if we count 1, 2, 3, 4, 1, 2, 3, 4. So these 4 candles represent 1 hour. So, and here is a bearish candle, 1, 2, 3, 4. So this is an order block on a higher time frame, even though this is a 15-minute chart. Okay, so we mark that up as an order block. Okay, now price fell from that position. When it fell, what happened? Well, over here is a fair value gap we can see on the 15-minute chart. So we mark this up as a fair value gap, and when price came into our fair value gap, it closed our fair value gap. Sure, it wicked and closed above, but this is a lower time frame. It will be a bit choppy, and we can see that on the higher time frame, right there, this is our order block on the 1 hour. Look at that. And if we go down back to our 15-minute, our close of our fair value gap was our entry. Because we are trading on the 15-minute time frame, we are selling. So we can see here, this would have been our entry on the close of the fair value. Stop above here, let's say at our breaker, or it's a 15-minute chart, so you could probably use a higher stop loss, but you generally don't want to use more than 30 pips, depending on what your scalping strategy is. But you can see here that if you'd entered on the fair value gap just by taking a scalp, this would have been a 90 pip move based on the scalp. But you should generally use a 30 pip stop loss. But there's a good example of a 15-minute trade we just took. I just showed you the higher time frames to give you some bias as to how the candles form on a higher time frame. But we only used the 15 minutes to frame up our order flow, our breaker, our source, and we saw an order block created on the 15-minute, and I showed you how it was produced on the 1 hour. The same is applicable. And you can see when price fell from this order block, it came back up to retest our order block. So we know that we can test, when we test our order block, we can have a sell. So when this 1 hour order block was created, we can see that price wicked into our order block on the 1 hour right here. There's our order block. and price wicked into our order block. Or we could have sold over here on the 15-minute chart for the 1 hour. Look at that. Another fair value gap right there on the 1 hour chart. So when you are trading on a lower time frame, you need to also know, say, the 30-minute and the 1 hour. You can't just trade only the 15-minute. You need to see what's happening on the high time frame to give you some directional bias, because you might be wanting to sell, but the 30-minute and the 1 hour is telling you to buy. But we traded off the 15-minute here successfully, and we could have either gotten an entry on the 1 hour fair value gap close or the 15-minute fair value gap close. So there is a perfect example of a good trade based on the 15-minute chart. And you can even go so far as to, when you are trading a 15-minute chart and you have a directional bias of the price being bearish, anytime you see that there is fair value created, you can trade just the fair value. Someone asked earlier about sell stops and buy stops. Well, I wouldn't trade fair value gaps and lower time frames using those limits, or the sells or the buy stops. The reason being is you want to be executing your orders and be in front of your chart when you are scalping and when you are trading lower time frames, because the trade duration is shorter than it is a higher time frame. So we have a directional bias over here that price is bearish. So anytime we see a fair value gap that is not filled, and price moves sharply to the downside, well, you can sell on a fair value gap and price continues down. And the same can be said. Let's go look at a 5-minute chart. The same can be said. Obviously, your spread needs to be tight and you need to know the higher time frames directional bias, but the same would apply. Here is a fair value gap, and that fair value gap was closed. So here's a fair value gap, price traded into the fair value gap. And again, here is a fair value gap on a higher time frame. So this is a fair value gap on a 15-minute chart. As you can see there, that is a fair value gap on a 15-minute chart. On a 5-minute chart, it is also a fair value gap. Even though the wicks intersect in some points, it's still a 15-minute fair value gap. And again, a 15-minute fair value gap. So there's plenty opportunity for everyone to take trades based on lower time frames using smaller, higher time frames, meaning the 1 hour, the 30-minute, the 15-minute, and the 5-minute. If you are using those time frames, generally your trade will be of a shorter duration than the 4-hour or the daily or the weekly time frames. So your intradays will be longer, your swings will be longer to play out than the 15-minute, the 30-minute, and the 1 hour. But there is plenty opportunities to take trades based only on lower time frames. And this happens frequently. So anytime you see a order block on a 1 hour time frame, well, you can basically look for a sell entry. So here is an example of a 1 hour order block that was created. Cool, let's go down to the 15-minute and see if we can see an entry. So 1 hour, here is the 1 hour, and this is the candle that closed, creating this 1 hour order block. So we go to the 15-minute and we can see that that is the candle. Let's just double check that. Yes, 15-minute time frame. This is the candle that created on the 15-minute the 1 hour order block. And we can see on the 1 hour when it was created, price would like to retest this 1 hour order block. So we go down to the 15-minute and we see that on the 15-minute, when price sharply moved to the downside, there was this fair value gap on the 15-minute time frame in purple. Price traded into our fair value gap and went down. So you can see how our strategy that we use with the institutional order flow can be used on lower time frames. Essentially, the time frames also determine which way you want to trade, like I've said over and over again. So we know that the 1 hour order block was created. On the 15-minute, we want to look for a sell. And let's go look for a bullish scenario. So over here, these three candles on the 1 hour chart were traded through by two candles over here. So 1, 2, 3 hours of price action to the downside and 2 hours of price action to the upside. So these two green candles, bullish candles, replaced these three bearish candles, creating ourselves a bullish order block on the 1 hour time frame, just like that. So when price comes in here, we see 15-minute time frame. Let's go follow that. Well, we can see that there is a huge amount of void in liquidity over here on the 15-minute. So where do we take our entry? Well, if you had wanting to buy over here, you would not have been filled in your entry because price did not come into this fair value gap. Sorry, let's just make this purple over here. So if you wanted to enter here, price did not close this fair value gap, but knowing this is a 1 hour order block, this fair value gap here was closed. Okay, so when this fair value gap was closed, price rallied up on the 1 hour time frame. We can see that. So that 15-minute fair value gap was closed. This 1 hour order block was created. Price came to the zone and rallied up again, creating ourselves another order block over here. Okay, so we just follow what's happening based on the price action. So here's another order block. Let's go down to the 15-minute. Okay, let's see. Well, here's the order block, and let's see fair value, fair value. Well, here is a fair value gap. Right over here, we have two order blocks on the 1 hour chart that were created for us, and we can see that this is a fair value gap right over there. And when price came into the fair value gap, bouncing off of our order block, our second order block at the bottom, this is a good buy opportunity. And if we put our entry at the close of this fair value gap at the top, and we put our stop below 30 pips, well, they're 100 pip move for you based on what's happening here, more than 100 pips. But you get what I'm saying is you don't want to be in a negative. So all I'm telling you is you can use all time frames to trade. All order blocks work. All time frames work. 15-minute, 5-minute. Let's look at the 5-minute in this zone here. So what happened? Okay, well, we have a 1 hour order block in this red box over here. We have this 15-minute fair value gap over here. And we also have a 5-minute bullish order block. This is a 5-minute bullish order block. Even though it's not a strong order block, it's still an order block on a 5-minute chart. So you can use multiple confirmations to take your trade. So when price retests this order block inside of closing this fair value gap, bouncing off of this 1 hour order block, price rallying up, price rallying down, closing our fair value gap, creating ourselves a 5-minute order block, price retesting our order block, boom, there's your entry, 5-minute order block. Price rallies up. So even though this move is not very long, that is still 40 pips for you. So even if you want to exit the trade when price retraces, well, there's 22 pips for you. And price goes again, 45 pips. But obviously you need to manage your trade. So you could have banked 46 pips or 40 pips if you see price retracing, or if you were scared and you exited early, well, there's 22 pips for you. So it's all about using your multiple time frames and your concepts that I've given you as tools to frame up yourself an entry based on any time frame. Any questions? No questions. So we're all happy. You're going to know how to trade on lower time frames now.
Yeah, thank you, Darren. It just needs more back testing, and then we could get it right. Thank you.
Yeah, all you need to do is go and test it. Exactly. So you're not going to get this immediately, but what I've shown you here, you can go and watch again on the recording on YouTube, and you will see that all I'm doing is basically using what I've given you already to be able to take the trades that I've just taken here. So obviously trading in a live environment is a little bit different, but the same rule applies. You find confluence, you find confirmation as to where you want to take the trade. You don't just take trades because you think price is going to do something. You just need to see what price has done and what price can potentially do, and then you take your trade.
Thank you.
Yeah, exactly. So once you guys test this and you re-watch the video and try and trade off lower time frames, you will formulate yourself some good questions. But you need to obviously practice this in able to create yourself some questions. So all I did
All right. I got
was,
something.
yes, what would you like to ask? Who wanted to ask a question? Emmanuel, Benson, you wanted to ask a question?
Okay. Darren, thank you. What I actually wanted to ask is a bit different. Okay. The last time that we had some session, you talked about IPDA, interbank price delivery algorithm. So, is there a possibility we are going to get more discussion on that in more sessions to come?
Well, it's a bit above you guys now because you won't be able to adopt that right now based on what
Okay.
I've shown you. I need to tell you more. It's sort of like a puzzle, and the concepts I've given you need to be introduced to you in a sequential order so that you can formulate a strategy to trade. So I've already given you three or four concepts, and I've given you the institutional order flow, which is a trend following strategy. So you can follow the trend and take trades based on using the concepts like I've shown you with the fair value gaps, institutional price levels, order blocks. Those are very powerful concepts, and everything I introduce to you guys after this will just build further and give you more confirmation. So at the end, when we look in, say, 2-3 months from now, and there's 10 videos on YouTube, you will be able to take trades on any of those 10 concepts individually, or just use one, or just use two, or just use five. It's up to every individual to decide what concept speaks to them the best and how maybe that suits their trading style. But obviously, they can all be used individually or together. And obviously, the more you use and the more you can put on the chart, the better your trades are going to be. But there's nothing stopping you from just using one or two, um, confirmations. Like I did now with the 15-minute, I just showed you an order block with a fair value gap. Regardless of the source, regardless of the breaker, if you're taken trades based on order blocks and fair value gaps, there's two confirmations only. I didn't even show you price with the institutional price levels. So do you see that everything I show you, there's a reasoning behind it? It's not to overwhelm everyone with knowledge all at once. And you've got so many videos to watch, you don't know what to do with all the information. You need to build it slowly and build on what you've learned, because what has taken some of you 2 weeks or 2 months has taken me more than 2 years to build.
Oh my God.
So even though some of you guys are trading very well, it's going to take you more time to build a better portfolio for yourselves. You can't just come out running, hit the ground running. You need to walk, walk faster, jog, sprint. Slow gains.
Thank you very much. Thank you.
How can I know when the OB is being formatted, Emmanuel? What is formatted? Formatted like a hard drive formatted? Do you mean how do you know when the order block?
Sir, maybe he meant violated.
No, formed. How it's being formed. Okay, so
Formed.
there isn't a way to know until price shows you it's formed on the time frame that you look at. So sometimes you'll look on a 4-hour chart and you might see, maybe I could find an example here for us, where you think an order block looks like it's going to be formed and then it's actually just a wick. And when the 4-hour chart shows you that the candle closed, it's not actually an order block. I'm just trying to see if I can find an example of that here. But you need to wait for candle closes, essentially. You can't just know when it's formed, if that helps you. You need to wait for candles to produce the order block. So if you look at the chart and say the candle close is coming in, 10 minutes, well, then it's most likely an order block. But if you look at the 4-hour chart and it's still 3 hours to go before the 4-hour candle close, well, the price can go any way, and then that doesn't mean that order block is formed. So that's why you can use lower time frames to see if order blocks are going to form. Like I've showed you here, that here's a good example. So 1, 2, 3, 4. So this represents 1 hour, okay, of price going to the downside, okay? So this bearish move to the downside, and then 1, 2, 3, 4 is an order block, because these down candles were traded through by bullish price action. So if we look here, 1, 2, 3, 4, so that's 1 hour. So this move to the downside represents 1 hour, and this move to the upside represents another hour. Okay, so this is a 15-minute chart. So you wouldn't be able to predict if this is going to be a bullish order block. So let's just look at this on the 1-hour time frame. Well, there is your bullish order block. Okay, but on the 15-minute, if you were looking at the chart, say at this candle over here, which was only representing 30 minutes of data, there's no way you would have known, or I would have known, that this would have been a 1-hour order block, because price did not tell us yet that this was an order block. But we could have been in the trade based on a strategy we were following, where we see that this is a fair value gap, and we know that price likes to close a fair value gap. We could have also taken a trade based on this here, that these two down candles over here represent 30 minutes, and this 1 15-minute candle engulfed this whole area. So this creates an order block for us. So what do? We enter price on the opening candle of the order block. So that's a 30-minute order block right there. So there's our entry. So we could have actually entered based on the formulation of these two down candles being traded through, creating a 30-minute order block on the 15-minute chart, and we could have entered over here or even here, because price didn't come down, so we're expecting price to go up and close this fair value gap over here, because this is a 15-minute chart. So to recap, this is two bearish candles to the downside representing 30 minutes of data. This 1 15-minute candle here closed above the 30-minute move to the downside, creating an order block for us. Okay, we also see that there is fair value here in price. So if we pull this across, we can at least expect price to close our gap before we can exit the trade. So what do? We enter price at this area here, okay? We use our stop just below this candle. So there's a, say, 16 pip stop, and here is 12 pips, okay? And once price moves past 10 pips, because we're scalping, or 5 pips, depending on your spread, we put our stop at break even. Maybe we close some over here, and we just ride the trade out. So all we did there was just take a trade based on a formulated order block on 2 15-minute candles, and there we go. There's our trade. So just like that, trades can just appear on any time frame. If you are looking at the 5-minute or the 15-minute or the 30-minute or the 1 hour, you can trade on lower time frames. It's just up to you what time frame you want to trade on. I wouldn't recommend trading on the 1 minute. It is quite choppy, but you can trade on the 1 minute. So let's look at the 1 minute quickly. We've got some time left over here. If we look at recent price action data on the 1 minute, well, the 1 minute represents a lot of choppy data, like I said, but we can still see on the 1 minute that here is fair value. There is no green candles replacing these black candles. For every seller, there's a buyer. So you can expect price to retrace into this zone to close some of the sellers that were in this position. So when price retraces and creates an order block here, so when this three black bearish candles over here get traded through, we will enter our trade because price is now stopped going lower and traded through 3 minutes of data. And if we entered here, put our stop just below, let's say 5 pips over here, and now we are waiting for price to close. We put our stop at break even once we get into about 5 pips of profit, and we just let the trade go. 11 pips. Depends really on the person that's trading, how much scalping they want to do and what the value of their pip is, because you can imagine someone who's trading with a 1 lot size gets $10 per 1 pip, whereas someone trading with a 0.10 lot size gets only $1 a pip. Someone trading with a 0.01 lot size will only get 10 cents a pip. So it's really up to the person who's sculpting and their trading plan. Any last questions before this 4 minutes ends? Now's your time, guys. 4 minutes is almost up. Okay, no questions? Fine. I'm going to continue with what I was saying about the lower time frames. So when we get this peak formation high over here, and we have a 4-hour order block created over here, right there, there's our 4-hour order block. We can see that there is huge amounts of liquidity void over here. We can see also that price traded to the 50% of this liquidity void, and price fell off again, leaving the remainder of this fair value liquidity void, whichever you would like to call it. So we can expect price to retrace back into it. So when price drops to this low over here, price starts to retrace and starts to go higher than our previous 50% of our fair value gap. So when price trades into our 4-hour order block, let's go down to the 15-minute and see if we can see price, where was that? 10th of April. Don't have enough chart data on here. Oh dear. Okay, no problem. We will find another one. So again, 4-hour order block over here. When price trades into this 4-hour order block over here, we just go down to the 15-minute and see if we can take ourselves an entry. So here is our order block. That is our order block. And let's just make this quick. So 4-hour order block, and when price trades into our 4-hour order block over here, we can see what is here. Well, this is an institutional price level of 200 right over there. And we can also see that there is liquidity that has been taken over here, and there is a fair value gap over here that needs to be targeted. So this is a 4-hour order block. We would want to sell because it's a bearish order block, and this would be our target. Okay, now although we can see price didn't come into our target, we could have still sold based on the target here. So this is a 15-minute order block. Because it is a low time frame, you can see that price traded through this green candle over here. This bullish order block was traded through. So when price comes to retest this order block on the 15-minute inside of this bearish 4-hour order block, we can look to sell when price retests this 15-minute order block, because it is also a sell inside the 4-hour order block. So forget the chart data that occurred over here. We are looking to sell here. So if we had entered over here at this 15-minute order block and we tried to rally price down, well, there's a move to the downside of 22 pips. Now, sure, we are scalping, so our pip count may not be as high as an intraday or a swing trader. So these are the kinds of entries we will be taking, and we can formulate trades based on all of our confirmations we have already. RPL, order block, fair value gap. So these are the things we need to look out for. And that looks like we are out of time for tonight, but we can have another session soon.
Darren, sorry, let me digress a little bit.
We don't have enough time. It's going to run out now. Less than
okay.
But you can ask it on Telegram. I'll